But what gold is doing right now, in my mind, is not as much about gold rising. It's rising against all of the G7 countries. It's more reflective of all the G7 countries being pieces of shit printed on paper that are all collapsing. And so as these currencies collapse, the price of gold goes up. This is the whole premise of revaluing the price of gold. It's not to revalue gold to make our gold holdings worth more to back the treasury. It's to devalue the dollar. Pullback's coming. Bullshit, it's coming. Yeah, it may come, but what is the real price of gold? Does anybody know?
A lot higher. It's a lot higher than this.
What is price discovery? He says they'll let it rise much higher, quietly, slowly, without attracting the attention of the Western public, so that then when they do revalue it, it's from a much higher point and less ammunition needs to be spent. So I think it's going to go higher than anybody thinks.
The old 60-40 portfolio is no longer reliable. Andy Schectman emphasizes that bonds no longer provide the safety investors once depended on while stocks face increasing risks in a changing global economy. He points out that some of the world's biggest institutional players are quietly moving into gold and silver, a shift he calls unprecedented in his 35 years in the industry. This change in sentiment is not only coming from central banks but also from respected Wall Street voices, who now argue that a meaningful allocation to precious metals is essential. Andy highlighted the work of momentum analyst Michael Oliver, who believes silver is on the verge of a major breakout. He explained that Oliver compares today's setup to past explosive moves in 1979 to 1980 and 2010 to 2011, where silver skyrocketed. If the pattern holds, Andy noted prices of $100 to $200 silver are entirely possible. Oliver is also bullish on gold, pointing to a breakout from a 12-year momentum channel that suggests new all-time highs are imminent. For Andy, this shows that the metals are entering a new phase, one defined by structural strength rather than short-term speculation. More importantly, Andy emphasized that gold's rise is not just about appreciation in dollar terms, it is rising against all G7 currencies simultaneously, reflecting the weakness of fiat money systems weighed down by overprinting and debt. He pointed out that institutions like Goldman Sachs see gold at $5,000, Jefferies projects $6,600, and analysts like Luke Gromen believe the metal will be allowed to climb gradually until a formal revaluation is inevitable. Pullbacks may occur, Andy stressed, but they do not change the long-term trajectory. In his view, the real price discovery for gold and silver lies far above current levels, and the world is only beginning to catch on. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
You look at what Michael Oliver says. He says that he expects the lid to come off on silver over the next several months into the Q1 of next year and sharply be revised upward. He thinks that the technicals of both price and momentum, he's a momentum guy, are showing you what's about to occur and is already occurring. He calls it vertically upside vertically, verticality, he calls it anyways, I think, and a repricing of silver's reality, he said. He shows a log scale chart of 1979 and 1980 and 2010 and 11. And he says if it follows the 1979, 1980, $100 plus silver is easy. If it follows the 2010, 11, $200 is easy. And, so I think that, and he says the same thing. He also said something that, you talked about. I have it right here. Let me he says that they expect to see a corrective jolt at some point in the current upward progress. And not to be fooled by it, that pullback will be normal. But he said that the best will, if it follows the way it did before, that the best upside potential will come after that pullback. He also talks about gold in being, as he calls it, a breach of a 12-year-old gradual uptrend, a parallel channel. On momentum. He's a momentum guy, and he's not as much on technical analysis as he is on structural momentum.
Okay.
But he says that it was broken out of last month, and that he expects this month, which only has a couple days left in it, to reach all-time high closing for a month. And we've already seen the intra-month all-time high. And will we see a all-time high closing? There's a day or so left, and we might. So, you got momentum. You got central banks. You got institutional traders here in the United States. You have the only thing holding it back is that the Western public, people here in the West, they don't recognize what gold is.
Yes.
They may see it rising, but what gold is doing right now, in my mind, is not as much about gold rising. It's rising against all of the G7 countries. It's more reflective of all the G7 countries being pieces of shit printed on paper that are all collapsing. And so as these currencies collapse, the price of gold goes up. This is the whole premise of revaluing the price of gold. It's not to revalue gold to make our gold holdings worth more to back the treasury. It's to devalue the dollar.
Yep.
Which enables us not only to pay off the debt easier, but to bring back manufacturing and sell our products to the world. This is Triffin's dilemma. Triffin's dilemma, for, again, we've talked about it. It says, and Vance wrote about this on White House letterhead. He's interviewed and said being the reserve currency isn't good for us anymore. It's a subsidy on the consumer. It's a drag on the producer. But it is that if you are the reserve currency, the world cannot get enough dollars from us alone simply through trade, that we need to provide dollars to the world, and that happens by them selling their currency to buy ours, which weakens theirs, which strengthens ours. And over time, this constant strengthening of our dollar against the world's other currencies hollows out our manufacturing because it's so much cheaper to make it over there, and you'll always have trade imbalances. And that's what Vance is saying. So everything that they're doing, including letting Stephen Mirren, and remember what the analyst for Goldman Sachs said, gold will hit 5,000 like that if the market believes the Fed has lost independence. Well, what fucking independence? Stephen Mirren is Trump's advisor, and he just kind of slides into that open, vacated spot, and he's the architect of the Mar-a-Lago Accord. I mean, the point of it is that they're transparent if you allow yourself to connect the dots. Maybe that's what I'm good at. Maybe that's why Jake calls me the time traveler. Going back to 2019, talking about BRICS and the Belt Road and the Saudis and the lack of the dollar hegemony, it was easy if you connect the dots. And reclassification of gold and the central banks buying and repatriating it and all the stupidity we saw in the previous administration, you couldn't help but see where we are going. Well, right now, they're telling you. When Trump says he who has the gold makes the rules, when Bessent is a self-proclaimed gold bug who wants to preside over a new Bretton Woods, a new monetary system, who wants to remonetize the assets of the U.S. balance sheet. What assets? Largest asset is student debt, 45%. And then you got military, and then you got land. Okay, put some hotels and amusement parks on the land. Not remonetizing it, remonetizing gold. And the only reason he backed away from that statement, because he said it in February, and they said, dude, what are you doing? We need to bring more gold back. Shut up. It's not time to say that yet. And then Trump on Easter Sunday, he who has the gold makes the rules. And Judy Shelton saying we're going to peg gold to the bond market. And now the Federal Reserve writing about gold revaluation. I mean, you can't make it up. So follow the crumbs. This is all about the Mar-a-Lago Accord thesis is of a massively devalued dollar. And there is no independence at the Fed anymore, period. So $5,000 gold should be coming right around the corner. That's what Goldman Sachs says, 6,600 by Jefferies. But that's what Luke Groman says. Smart dude, maybe smarter than anyone in this industry. He says they'll let it quietly, the frog in the pot of lukewarm water, turn up the heat. They'll let the price go higher, 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 higher. And all the naysayers will say, pullback's coming, pullback's coming, pullback's coming. Bullshit, it's coming. Yeah, it may come. But what is the real price of gold? Does anybody know?
A lot higher. It's a lot higher than this.
What is price discovery? He says they'll let it rise much higher, quietly, slowly, without attracting the attention of the Western public, so that then when they do revalue it, it's from a much higher point and less ammunition needs to be spent. So I think it's going to go higher than anybody thinks.
Andy stressed that this mindset is now outdated. He highlighted that over the past 25 years gold has dramatically outperformed the 10-year treasury, even doubling its returns since the start of the century. He also noted that gold has even narrowly beaten the S&P 500 over that same period, including reinvested dividends. Andy further pointed out that last year gold rose more than 40% while the 10-year treasury returned just 4.5%, and that even this year, when accounting for the dollar's decline, bond investors are sitting on negative returns while gold is up over 50%. He pointed out that Morgan Stanley's chief investment officer is now suggesting a 60/20/20 portfolio with 20% in gold, while Bank of America's Michael Hartnett recommends an equal 25% allocation to stocks, bonds, short-term treasuries, and gold. He also mentioned that Chris Wood from Jefferies is projecting gold to reach $6,600, and even Jeffrey Gundlach, famously known as the Bond King now, says that 10% gold is the minimum investors should hold, and that 25% isn't excessive. Let's get back to the interview.
Well, in my viewpoint, we have, there's that 60-40 mantra, that 60% stock, 40% bond, that has been prevalent in financial advisory circles for decades now. And it's proven to be a good strategy for a long time. If you go back to 1982, when interest rates have fallen at a 45-degree angle for the better part of 40 years, anything in traditional assets, stocks and bonds and real estate would have done very well. And that's been a mantra. People would always get a 5% allocation, acquiescence from their advisory. Sure, go ahead and buy 5%. And it's silly, because if you look at the last 25 years, as I've mentioned on your show before, Jared, gold has doubled the performance of the 10-year treasury since the beginning of the century. It's beaten the S&P 500 over that time frame, even with dividends reinvested, which no one ever does. 9.9% for gold, 9.6% for the S&P. You can look at last year, where gold was up over 40%, the 10-year treasury up 4.5%. You can look at this year at a 4.25% treasury, even call it 5%, which it's not, called 4%, more accurate. 3/4 of the way through the year, you're at 3% return with the dollar down 11%. You're a negative 8% return so far in treasuries this year. Gold's up 50. So, there's all of a sudden this new mantra coming out of Wall Street. The chief investment officer of Morgan Stanley comes out and says, instead of a 60-40 portfolio, investors may want to consider a 60-20-20 portfolio. 60% stock, 20% bonds, 20% gold. And you have Michael Hartnett, the big-time advisor for Bank of America, who has a big buck letter that he puts out for the the institutional traders, paying big money for his analyzing of world events, not just the market. And anyways, he says now we should go 25, 25, 25, 25, which would be 25% stock, 25% bonds, 25% treasuries, which would be the short-term version of the bonds, the treasury notes, like up to 6 months or so, 25% gold. You have Chris Wood, who is the global head of equity strategy at Jefferies Bank. Jefferies is a bank that I have a lot of fondness for. Before Jefferies bought Prudential Beige. Prudential Beige nominated Miles Franklin as an authorized reseller of U.S. Mint products. Prudential Beige used to be one of the 6 or 7 U.S. Mint primary distributors. We were nominated by Prudential many years ago, 15, 20 years ago, to be an authorized reseller, one of only 27 in the world. Jefferies purchased Prudential Beige. Prudential sold to Jefferies. Jefferies got out of the gold market about a year after they took over, but they understand gold. They were one of the world's primary distributors for all the major mints. They're now saying 6,600 for gold. And then you have Jeffrey Gundlach, who is known as the Bond King, and Jeffrey works for BlackRock, who manages like $11 trillion. And Jeffrey is saying that you ought to have at least 10% of your assets in gold, minimum. And so you have all of the big money all of a sudden. Not only are they revising their projections, 4,000 is easy, up to 6,600, you have them really saying, look, it's this stock and bond trade that has put all of these people on the map. And now they're saying, yeah, maybe we should back off of that bond allocation and go heavier into gold. It's one thing when I tell you that the central banks are buying.
Yep.
Which is, as far as I'm concerned, all you ever need to know. It's another thing when the most widely revered and successful traders on the globe, the institutional traders on Wall Street, start doing this. And then you really should stand up and take notice. So, yeah, I think there has been a change in the way that Wall Street is looking at gold. And, I just think that, in fact, Jeffrey Gunlock, which blew me away, he said 25% in gold isn't excessive. That's what he said. 25% isn't excessive. And so 1/4 of your portfolio in gold isn't excessive. And this is from the guy that made his mark selling bonds. And, so I think that this is something that I've never seen in 35 years. And I think that's part of the reason you're seeing things really start to move in a different direction. The world, the big money is catching on that gold and silver are far more integral than we've been led on to believe for all this time. I also think that, this stablecoin Genius Act is going to have a lot to do with gold going higher, because you look at Tether, Jared, and Tether is the biggest stablecoin company by far, USDT, and it just came out with this new USA stablecoin, which will be backed 1-to-1 with U.S. Treasuries. And it's interesting that their CEO is a guy named Bo Hines, and Bo Hines was Trump's crypto advisor until recently, and now he's profiting from the decisions they made. The rules of the Genius Act say that every USA stablecoin, which will be issued not only by banks but insurance companies, credit card companies, instead of them wiring money, they'll just send stablecoins immediately. But so anyone who wants to use these digital dollars, in essence, are forced to lend money to the government, is what you're basically saying. But what's interesting is that Tether backs all of these stablecoins with treasuries. The interest on the treasury, the short-term treasury, does not go to the owner of the stablecoin. Tether keeps it. But with the profit, they're buying more treasury bills, and they're also buying gold. They have $9 billion worth of gold sitting in Swiss vaults right now. They were just at the last week at the Beaver Creek Gold Summit for all the mining companies, dealing directly with them. And so they're taking all of their profit and converting it into gold and into treasuries and maybe into Bitcoin. The idea here is that buying gold and Bitcoin, in particular gold in this case, will continue to devalue the dollar. At the same time, buying all of the treasuries will in this synthetic demand for the treasury, not only will help lower interest rates, but taking all the profit and buying more treasuries will continue to lower interest rates, and then putting more into gold and gold mining will continue to devalue the dollar by raising the price of gold. It is genius. It's diabolical. But, I guess when you got guys like BlackRock and Gunlock who built their reputation betting on bonds, when these people are starting to bet against their own game, I think you should pay attention to it. So you have central banks hoarding it. You got Tether hoarding it. And you have everyone who knows how the game works buying it at the same time. I think that is what is different in a big way, is that the big money is now taking notice.
The signals are becoming impossible to ignore. Traditional portfolio models are breaking down, and the most informed players in global finance are positioning themselves not for speculation but for survival and real wealth preservation. Gold and silver are no longer alternative assets. They are quietly being restored to their historical role as foundational stores of value. While most investors wait for mainstream validation, those who recognize the shift early will be the ones who preserve purchasing power through the next monetary transition. The revaluation of hard assets isn't a future event, it has already begun. What role should gold and silver play in today's investment portfolios given the rising momentum and signals from central banks and institutional investors? Stay tuned For clear, data-backed insights into the financial system, be sure to like and subscribe so you never miss our weekly updates. Thanks for your support, and we hope you enjoy the video.